This meeting is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. Back with my Wall Street guy, someone who's got 10 years of experience trading big money in the markets. And who better to have on a Monday when the stock market's going crazy, up, down, sideways, just a lot of crazy stuff going on. Taylor, how you doing?
I'm doing great. I don't know that I'm going to be the expert that can, explain what's going on here, but I'll do my darndest.
Well, what I've come to appreciate after 6-8 weeks of doing this together is we just kind of talk about what's going on and we give our opinions and then we just do it again next week. So it is
that's it.
All
we
good.
See how right or wrong we were, right?
Exactly. That's okay. We take a shot to educate, entertain, and have some fun together.
And I will say this, and this is not us tooting our own horn, but looking backwards, at least until now, granted, super short period of time, we've been directionally correct because we've been pretty, I don't want to say negative on the market, but we've been cautious on the market. That's what we've been saying. And obviously, even coming into this 6 to 8 weeks ago that we started chatting, the trend was downward, but it certainly hasn't gotten any better.
Well, yeah. And again, some of the words I choose to use on my channel, my thumbnails, is meant to shock people, right? And you and I have been talking about dumb money, smart money. And oh my God, the dumb money, I think the dumb money might be waking up, but folks, it's not here yet. We have not had capitulation. There's not true fear. We've had the VIX spike to over 30 a couple of times, but I don't think we've seen anything yet. But you've brought some interesting numbers about comparables, right? The average investor. And again, I go back to David Portnoy a couple of years ago, talking about just spanking good old Warren Buffett's ass. And anybody can make money when the Fed's with you. Guess what? The Fed's not with you anymore. Let's see what you're doing, buddy. And not good.
Yeah, it's tough. And Warren is a hot topic today just because over the weekend was their national conference out there in Omaha. And he had a great quote. He said something to the regard of, I'm going to butcher this a little bit, but he said something to the regard of inflation swindles all.
Yes,
so he talked
swindles
about
everyone.
Stock investors.
Yes,
swindles everyone. Okay, there you go. So he talked about stock investors, he talked about bond investors, and he talked about those who keep their money under their mattress.
Yeah.
Inflation is an environment that unless you're really old, which he and Charlie
are really old,
that they are.
They're both over 90. So yes.
Yeah, it's 98 and 91. They have almost 200 years of wisdom there, but they are still so sharp. Now, it takes them a long time to answer a question, but nonetheless, inflation is a really tough thing to handle, and it's been a long time since we've actually had inflation here in the United States. There we go. Yeah. So no doubt it's definitely a different environment that we're in. And to your point, when it comes to the average investor versus what the actual indexes do, it's dramatically different. So if you just look at the S&P 500 over the last 20 years, the S&P 500 has annualized 7.5% per year. So it's been pretty solid. 7.5% has been the return that you've seen. Yet the average investor's return has been 2.9%.
Yeah.
2.9. How does that settle with you?
Well, that just tells me good old, Warren Buffett or Ray Dalio, just do some index fund investing and stop chasing your tail, going after the meme stocks. And certainly David Portnoy, stop saying you're better than Warren Buffett because you started it at the absolute right time.
Oh, anyone who says that at some point is going to come out looking like an ass. Warren Buffett's done 20% per year since the inception of his product.
Yes.
Since the inception of Berkshire Hathaway, he's doubled the market. So you're going to come out looking like a fool if you bark up that tree. And so I would actually argue this, Michael, and you can tell me I'm a fool myself. I would say that most people investing in an index may not even be the right route. And the reason I say that is because I think even the index, call it S&P 500, you buy VOO or SPY, whichever flavor of it they want. They all do the same thing. They give too much volatility to the average investor, and the average investor even sells them at the wrong time.
Well,
if
again,
right now, people are puking, right?
Yeah, absolutely. Yeah, I mean, there is. So again, right. So let's break this down. I don't think you're a fool. So first off, the best portfolios are, they're not 100% anything. And a S&P index, whether it be, SPY or any other version, is 100% stocks. right? There is research out there, right? The traditional portfolio 60-40, whatever it is. You need to have other exposures, whether that be bonds or commodities or cash or whatever, right? Being 100% anything is there will be a time where that thing is out of favor, and bear markets are the time that stocks are out of favor, right? I mean, who would have guessed Amazon fell 15% on Friday? Friday, one day.
Yikes. And so Thursday, I'm watching the closing bell, and Amazon and Apple report right after the close.
Yep.
Apple reports what every analyst that's on at that point says, quote unquote, something in the regard of gangbuster numbers.
Yes.
The one guy went as far to say is they're going to hang this earning report on the wall in Cupertino. And even the ones that came in negative on Apple were like, holy shit, this was an awesome quarter for them. And what happened to the stock? What happened to the stock the next day? It's down. It's down 2 to 3%.
Yep,
and it's like, hold on, what's going on right now? And this is not what we're in is a market right now that's not an earnings. No, it's not an earnings problem. Earnings have been fine. It's a multiple problem.
Exactly. Yes.
So just to like explain what that means. This is an earnings problem, or it's not an earnings problem. It's a multiple problem. We came in, things were trading too expensive. Why were things trading too expensive? Because the Fed took risk to zero.
Exactly.
When the Fed takes risk to zero, it doesn't cost anything to leverage your balance sheet and go out and make money.
Yeah. I hope people are hearing this, because I've been telling them for a while, and sometimes it just takes repetition. Right now, we are in collapsing multiples. I forget what we came into last week. So this is last weekend. It was, I remember 22 or 26. I don't remember what it was. But anyways, the multiple was very high, historically speaking, and stupid at the start of a Fed rate cycle, right?
Correct.
So we are in a multiple collapse. And again, earnings could be fine. Earnings could frankly grow. And if multiple collapses, stocks are going down. Yeah. I unfortunately believe a recession is in the offing, and that will mean earnings destruction into collapsing multiples and probably a second leg down in the collapse. And whoa, then the party gets started.
It's an interesting take, and I can't disagree with you. We just had a negative GDP print.
Yeah.
And I don't know what to take of that. So I've done a lot of research as to where it came from. So last Thursday morning, GDP, which is, you can think of the economic report card for the United States, was expected by every analyst on the street. The average was positive 1.1%.
Correct.
It came out at 8:30. It was minus 1.4. That's a 2.5% miss. I was sitting here and I took a big swallow and I said, oh shit, this could be bad. And so we dug into the report a little bit. The one saving grace is that what caused it to be negative. Yes. So just not go into the details here, but essentially what caused it to be negative was kind of an accounting arithmetic, if you will. We brought in too much. We imported too much and didn't export enough to offset that, which is a negative on our GDP. And they blame that on inventory restocking in the United States. But at the end of the day, the consumer showed strength there, and the consumer was still spending. And I go, okay, the consumer's 70% of our economy. I totally understand that the strength that they carry through this time is probably the most important thing. But at the end of the day, GDP missed by 2.5%. It went negative. 2 GDP negative prints in a row mean a recession.
Yeah.
Thursday, the market was up 2.5%. What now? Friday, the schizophrenia took back over, and it was a bloodbath on the other side. And maybe some of that was a result of that GDP print. But I don't think you can look at this and just go, oh, okay, it was just the accounting mechanism of it all, and this is just fine. Our economy is still, rolling right along. That was a scary number.
Yeah, so it was a scary number. I can tell you exactly why the stock market was up. It was another excuse for buy the dip. People saw the negative 1.4 print. They know the Fed meeting's coming up in what would have been 4 days, business days. And they're like, they're not going to raise. They're going to cut. All of you guys are smoking crack. What are you doing? It's not going to happen. They got to. Inflation is up. Wage inflation.
Inflation's too high. Yeah.
Wage inflation is sticky and getting worse if you break down PCE from Friday.
Yep.
Yeah. Wages are up. And
Yeah.
that's the problem from the 70s. If they don't break the back of that, this is not good.
So what happens here? Play this one out.
Yep.
What happens if next quarter, now I don't anticipate this, but this is not a foregone conclusion. It's not going to happen. What happens if next quarter GDP printed negative?
Yeah.
What does the Fed do then?
You know what, folks? We're going to make that episode number 2. We're going to give it a little tease. Taylor, I love the tease. Where can people find you? Because you put out amazing stuff.
Find us at Life Goal Investments on Instagram is the best place. So at Life Goal Investments on Instagram. Thanks so much, Michael. Always good chatting with you.
Yep.